Look at that. He's got the stars and stripes framed in the background. This is a new view, Greg. I like the new digs you got there. How you doing?
I'm doing just fine. Thanks a lot, buddy. We moved offices recently, so I'm still. This looks okay, but if you were to look down, you'd see we're still.
I've seen your desk before. I'm sure it's full of paperwork, and you're a very, very busy guy. Let me shut down our poll question and share the results, and then I'll turn it over to you, Greg. So let's share the results here. So the majority of you, 62% of you, have gains from real estate. And then a pretty good portion of you, about 40% who answered, have gained from stocks, ETFs, et cetera. Pretty fair number of you with gains from privately held business, about a quarter of you, and then some from crypto and collectibles as well. So that's an interesting poll result there. And with that, Greg, I'm going to turn it over to you. You're joining us from Investors Choice Oz Fund by USG OZI.
Thanks a lot, Jimmy. And hi, everybody. And I'm really happy to say this is our, I think, third time with you on Pitch Day. And it's been, and I'm sure others have presented today already. So I hope I'm not saying anything somebody else may have already said. But Jimmy, you've done a wonderful job, you and your staff, and everybody at Opportunity DB over the last 2.5, almost 3 years of really being the leader in giving information to the accredited investors in the opportunity zone world. And it's really a good place for everybody to come together. So, and I've appreciated being on the podcast. You've done a wonderful job there. So this is really, I think Novogradac and you are probably the two places that I go to. I don't mean to give plugs to just two people, but those are really just two great places to go for just about any information you need, and of course EIG as well. So first and foremost, thank you. It's a great platform for those it's their first time with Opportunity DB. You're in great hands as far as a information resource. That said, let me jump into our presentation. I'm really happy to let everybody know this has been coming for the past 4.5, 5 months. Our new fund platform has just launched. And it's a multi-asset program that actually allows, it's the one and only, so far as we know, Opportunity Zone fund that allows the investors to actually pick and choose the projects they want to go into, and also the amounts of investment that they want to go into. But I will tell you, just real briefly, let me go off a little bit on the tangent. I really enjoyed watching those poll numbers because that coincides almost perfectly with what we're seeing as far as our own equity raising. This is actually our fourth fund with our partner, OZI, Opportunity Zone Investments. Between USG and OZI, this is our fourth program together, and it's about a 60-40 split between real estate and people selling businesses and stocks, et cetera. So that fits in very, very well. So kind of to jump in here, we're a company that launched a few years ago and are coming out with our new platform, which is called Investors Choice. And before I jump in, I just want to make everybody make mention that, again, we do everything through FINRA and the SEC, and therefore all of our presentations are approved and validated through our managing broker dealer. But this is not technically an offer to sell. This is truly an informational presentation, and we hope that you can join us at our breakout session afterwards to dig a little bit deeper into the investment. And of course, there's always risks when you're involved with any type of security. Just briefly, I'll cover for the group. We all know that this is actually the last year to invest in Opportunity Zone funds and still be able to attain the 10% discount in the capital gains tax. The only thing I'll mention, if you read through this slide, if you invest by the end of this year, you'll see by the end of the 5th year, you will have to then pay those capital gains taxes, let's say in April of 2027. But if you keep those gains, if you keep your investment in the Opportunity Zone fund through 10 years, your entire return from the Opportunity Zone fund is tax-free. What I will make mention is sometimes people will come to me and tell me that 10% is really not that big of a deal. And frankly, nobody should be investing strictly because of the 10% discount. But the way I believe most people should look at this is during the next 5 years, you're not paying any capital gains tax on your gain from your sale of your stock or your business or your real estate. And therefore, you have 100% of your gains working for you in your opportunity zone fund investment. So if you're getting, let's say, an average of 10% a year annualized in your opportunity zone fund investment, come year 6, when you owe the taxes, in most cases, there should be plenty of gain there from the opportunity zone side alone to pay your taxes. The slide I want to spend a little bit of time on is really what differentiates our platform from just about everybody else out in the marketplace. And if you look at the 3 types of funds that are available to the investing public, there are really 3 types of funds. There are the blind pool funds, which are the larger, I used to kiddingly call them the Scaramucci deals, meaning the big private equity funds where investors could invest in there and then they take it and invest where they believe the investment should go. Then there are the specified multi-project programs where there are 6 or 7 or 8 different projects within the corpus of your opportunity zone fund, and you invest equally along those projects. Then there are the single project programs. One project at a time, you invest up to $20 million, 30 or 40 or 50 million into each project. Personally, and our modus operandi is that we support really the single project side simply because the investors want to know what they're investing in. They want to know that their full investment is going into that project. However, this is the important part. When COVID hit, what we found is that investors started to want more diversification again. They also, a couple other things, they also wanted to make sure that they were bifurcated from the developer in the sense of taking away that conflict of interest when it comes to the developer controlling the investment itself. And then thirdly, it was that most of the best returns that we've seen have really come from the smaller to middle-sized regional firms. I'm talking about development firms that have a really good relationship with the local community. They know the local economic development alliances. They tend to have the very best returns and, quite frankly, can build projects much, much quicker. But their equity need is really between $5 to $8 to $10 million. And quite frankly, to the group, putting a fund out into the marketplace can cost anywhere from $500,000 to $1 million. So it doesn't behoove an investment manager like ourselves to bring out a fund unless you're able to raise 20, 30, 40, 50 million dollars. So what we developed is what we consider a 4th option in the opportunity zone world, and that is a multi-project fund that we co-partner with developers in regional areas around the country, and each one of the project needs for equity are between the $5 to $10 million mark, and it's incorporated into an umbrella fund of $50 to $100 million. And we've seen through our own analysis that these tend to give the better returns, and the demographics are such that you can be in these suburban areas that are adjacent to urban areas where you'll see a better corporate stability for your long-term gain. So that's why we invented and came out with what we call Investors Choice Oz Fund. It's the one and only multi-project investor-directed fund in the country. We believe it's a better way to invest in opportunity zones. We've been doing opportunity zones from the very start back in 2018. Very proud to say that our first fund that we came out with was named the top fund in the country by Globe Street. And we've taken that same dynamic that honors the spirit and intent of the initiative, along with pref returns of anywhere from 10 to 11 to 12% in each one of these pocketed strong demographics. And we've taken that and put it into one fund structure. So to give you an overview, our current projects right now, that we're actually taking money in are 3 projects. One in Lacey, Washington, which is near Olympia, just outside of Olympia, Washington, where the state capitol in Washington is. The state capitol is also the largest employer in the state, but there's also Costco and Starbucks and all the other ones that you know. Milwaukee, Wisconsin, we're co-partnering with a company called Ogden and Company for a multi-project deal in Milwaukee. Ogden and Company just happens to be the largest full-service real estate firm in the state. And then Bristol, Connecticut, we have an assisted living memory care facility with KindCare, which we're in the process of launching now. And then projects in Denver, St. Paul, Oakland, San Francisco, and Los Angeles that will be hitting our sheet very, very soon. Just quickly, I wanted to go over post-COVID and the dynamics that are happening currently in the economy. As we all know, we're in an environment right now where we're at historic highs in the real estate pricing area. So we believe that we're at the top of the real estate market as far as pricing, and therefore there's greater investment risk there. So everything we do, we want to make sure that we're performing the projects at the top of the market and not relying on anything aggressive in the pro formas. For those that understand cap rates, we actually decompress the cap rates in everything we do to get to our high 11 and 12% prefs. We're also in an environment, like we said, we're at the end of the real estate cycle, and so there's greater bubble risk. So given that you have a 10-year hold in opportunity zones, it's very important, as we like to say, we want to make sure our investors are the same investors owning the project at the end as they are at the beginning. So everything we do has to do with recession resiliency, recession resilient asset classes, very conservative pro formas, because we do believe there could be bubble risk out there. And then, of course, we're at an all-time high in the stock market right now. And this gives investors a great opportunity to take that gain off the table and rebalance it into a tax-advantaged investment portfolio like opportunities, which becomes tax-free at the end. And then also we're in the historic low interest rate environment, which gives us greater inflation risk. And unless you've been living under a rock the last 3 months, this has just shown up on everybody's doorstep, and that is inflation, which gives us much more greater uncertainty in the marketplace. And so this really precipitates a move towards tax-advantaged hard assets like you see in real estate. And of course, opportunity zones meet that criteria. The solution, as we see it, harvest the gains. It really gives you an opportunity to take the gains off the table in the stock market or in gains in your businesses. Rebalance the portfolio to reduce your inflation risk and your recession risk. And right now there is a big flight to hard assets like real estate. And then of course, maximize your tax liability, which of course the opportunity zone investing criteria does. Where we really show the differences between us and many of the other programs is, quite frankly, this. If you look at the 3 types of funds out there, blind pools, multi-project, and single project, you can see that our 4th choice, our dynamic, actually does everything that investors are looking for. It gives you that multi-project diversification, but also can give you that single project concentration that you want, and you get to choose how much you want to go into each project. We are asset manager driven over developer driven, meaning we co-partner with our developers at the project level, but where we make our money and where we actually guide things is from the fund level. So we're truly an investor advocate. We take that conflict of interest away from the developer and the investor, and we put ourselves squarely on the same side of the fence as our investors, as your advocate. And then, of course, you can have a tax opinion on our program, which gives the investor that safety and security of knowing that over the next 10 years, twice a year, you're going to feel comfortable about passing all the opportunity zone regulations, and you'll have a legal investment by the Treasury Department. And then, of course, third-party oversight and regulatory through FINRA and our managing broker-dealer. Something we do, which I haven't seen in others, but what we do is every one of our projects, in an attempt to do two things, and that is to honor the spirit and intent of the initiative, and to also show our investors that all these projects, on top of the high returns, are being accretive to a positive social impact in each one of these communities. And so we have a contract with a third-party group called DRC out of Washington, D.C., who does a social impact report on each one of our projects, and then an ongoing report every year after that, so you can actually see how your investment is benefiting the community. And then, of course, as I mentioned earlier, you direct your own investment where you want it to go. So an example of that is, let's say you have the Smiths here with $1 million. They may choose to put 500,000 or 50% of their investment into project one, 250,000 into project two. They don't want project 3 or 4, so they put the other 250 into project 5 for $1 million. The Jones, you can see how this works, $500,000 decided to go equal amongst all 5 projects. You have the Petersons here with $100,000 who put 50,000 into 2 projects. And then you have the Desmonds who had $3.5 million, and they decided to put their money into different percentages into different projects. So that's what we offer to our investors. And the last bit here, I want to talk about some of our highlighted projects. Before I do, I want to make mention of one thing that I believe is very important. Because of our dynamic and our methodology, what we are not is a platform for developers to sell their projects. It's the other way around. We actually have our own proprietary filter when it comes to due diligence and demographic filters and our asset class filters, and we put those developments through that filter, and then and only then do these projects become eligible for us to co-partner in this multi-project fund. So 3 that I'd like to highlight before I open it up for questions. This is Elevation 1659 in Milwaukee, Wisconsin. We're currently taking investments now in this, and we've got about half of it raised to date. It's a $5 million equity raise. This is a 76 unit market rate unit multifamily project with the largest full service real estate group and developer in the state of Wisconsin, Ogden and Company, just 1 mile from downtown Milwaukee. $5 million equity raise on a $20 million project. The returns in this particular project are built in because we do have HUD financing for both the construction loan and the permanent loan. So this is 221D4 HUD loan that we received through Colliers International. So therefore, the permanent loan after the construction is over is already there, and we expect around a 24 to 25% distribution back to our investors in 2025 with a preferred return of 12% to our investors. As you can see, the site is in throwing distance from the heart of Milwaukee. You've got Lake Michigan to your left, the Lincoln Center for the Arts. The Central Business District is less than a mile away. And it's actually, the site sits across the street from the Ogden developer headquarters. Next is KindCare, our assisted living and memory care facility in Bristol, Connecticut, 117 units. The developer here is KindCare, and their dynamic, we're very excited to be with them, is focusing on the middle income, middle market, senior living, assisted care, and memory care marketplace, which is very much underserved. They have a very unique structure that they have actually been able to lower costs to the residents by over 25% in a footprint that's less than 40% of a normal building. So this is a dynamic that's going to be taking off across the country. The operator is Charter Senior Living, one of the larger senior living operators and very strong prominence in the East Coast. And as everybody knows, Bristol, Connecticut is the home of ESPN, Xerox, and 12 Fortune 500 companies. And this is a $10 million equity raise, $26 million in project costs with a preferred annualized return to our investors of 11%. And as you can see from the site here, right in the heart of Bristol, Connecticut, near the ESPN headquarters. And also Bristol is an aging population. So this is, from a demographic standpoint, you have a strong corporate dynamic here, but also an aging population, which is what drew us to the senior living sector here. And then lastly, the one I'll highlight is Martin Village, which is just outside of Olympia, Washington, 180 units, multifamily. Developer is Dragon Wheel. You may or may not know this, but Olympia, Washington was ranked the second best place to live in the state. It's also just 5 miles from the state capitol. It's a $5 million equity raise. We're doing it in 3 phases. We're beginning to bring money in on this project. We just launched this one, as a matter of fact, with a preferred return of 12% to our investors. And then you can see that Martin Village is very, very close to Olympia, close to 3 universities, St. Martin University, Evergreen College, and South Puget Sound Community College. So it's a great place, and it's right in the heart of the Olympia area. So going back to our map before I leave it for Q&A, as you can see, multi-projects, you get to pick and choose, and we've got more projects coming online very soon. So one thing that's not on here is that we look to have a Sacramento project come on board here within the next couple of weeks. Currently, we have current reservations of about 4.5 million. So we still have about 23 million in equity available. The elevation deal is currently at 2.3 million, so we're almost half done there. We still have room available there, and KindCare at about 1.4 million in equity reservations. So we have some room there as well. Before I get off the stage here, our partners, you can't find any stronger, I believe. We've got ourselves at USG, our partners at OZI, DLA Piper, who does all of our legal, UMB Bank does all of our fund, our omnibus accounts for the fund and does all of our fund servicing. First Federal, which is a large regional bank in Washington, does all of our operating accounts. All of our financials are audited for the fund through Mosaic. Pinnacle serves as our managing broker dealer. And then all of our impact report, we do that through DRC Impact Reporting in DC. Lastly, it's a low investment minimum, $50,000 to our investors, 10 to 15% in annualized returns. And our waterfall distribution is 100% to the investor and 0 to us until we hit 100% return of capital to you. Then it goes to 90-10 at that point, and then 70-30, 70 to you, 30 to us, once we hit the pref of anywhere from 10 to 15%. On the unlikely case that we hit 115% of the pref, it's a 50-50 split. But in all likelihood, it'll probably be a 70-30 split. And you'll also notice that our preferred returns are quite high. Lastly, I'll mention that we are one of the few funds that offer a liquidity provision. If you should happen to need to get out of the fund between now and the end of the 10 years, we do offer anywhere from 92.5% to 100% of your investment back to you during the life of the fund. And because of our structure, we have multiple exit strategies that we can employ. We can do a portfolio sale to a REIT. We can sell the projects one at a time. We can even sell a few of the projects and stay in some of the projects if we want. And the investors are allowed to ride along with us long term if you should so choose. With that, Jimmy, I kind of went fast, but time goes by quickly. I'll open it up to questions here.
Yeah, time goes by when you're having fun, right? And I've never seen you not have fun, Greg. So tremendous presentation. Thank you. We do have a handful of questions. We got a few minutes to get to them before we spin off into that breakout session. I just posted the link for the breakout session that we'll be doing with Greg in a few minutes here. Please do head over there if you have additional questions for Greg. We may not get to them all, but Vicky asks, do you do rural areas with a co-partner?
Yeah. And I'm looking at some of these other questions. I want to get to them, but thanks, Vicki. The answer is yes. We really look for two things. We look at the asset classes from a recession resiliency, but in 34 years in the real estate securities world, I've always seen deals that work. I always look at the demographics. I let the demographics really guide me, and then I look at the asset class. So we're looking for demographics that they have a strong corporate structure around it. So it can be a rural area as long as it's close enough for stability for 10 years. But we want better than average population growth during that time period. And we want to be in an area that the local economy is actually behind it, behind those investments as well. So they're putting money into the economy as well. So it's all about stability and long-term benefits of the area. Secondly, going into your other question from another person about asset classes, thanks, Philip. Our main food groups really are, we want to be in multifamily with barriers to entry. We want to be in senior living, but we have to really focus on the demographics and the operator, storage, and then we also, look for industrial, but it would have to have a good tenant. Those are really our four food groups, but we can do anything we want, but we try to stick with those four food groups. And then Virginia, Tennessee, Missouri projects are no longer in the pipeline. So we had done due diligence on a deal in Missouri and Kansas City. Virginia, we passed on a deal. And I think somebody mentioned, I forget what the other one was, Tennessee, but we never looked at one, I believe, in Tennessee. Is there any deadline to invest in the projects after investment in the OZ fund? So once you're in the fund, that's a good question, Rick. We have a lot of investors who say, okay, I've got $1 million to invest, put $250 into Elevation in Milwaukee, put $250 into Bristol, and then in the omnibus account, we can keep the other $500, and then you can choose to go into other things that come on board. So you're not mandated to go into other projects, but we do have investors that will put all the money in the omnibus account, go into where they want. And I will tell your investors this is really cool. If you decide that you want out, because technically it's not in until it's in the project. So this hasn't happened, but an investor could actually go, hey, I found something else. Can you send me my 500 back, let's say, from the omnibus account before they decide? That's fine. We send it back, but you can hold it in our omnibus account and wait to invest.
Good. One more question coming from Philippe or Philip. I think it's Philippe. I'm going to say I'm pronouncing that right. You're pronouncing it wrong. When the project includes investment tax credit, how is that absorbed and distributed?
Yeah, great question. So the only way it could be absorbed and distributed, quite frankly, is it goes to the return. So if you have multifamily, tax credits like we do in some of these deals, it's absorbed into the fund itself and it goes directly out to the investor, but in the form of increased cash flow and increased return. And then the last thing I'll say before I get out of your way, because you probably have somebody else teed up here, and I haven't been watching.
We got a couple more minutes.
Oh, we do? Okay, I usually run out of time. Yeah. So I try to talk fast if I can. Our model for each one of these projects, I want to hit this home if I can again, is we really focus on those regional developers that don't need 20 or 30 or 40 million, but they need 5, 8, 10 million. It's a shorter time span to get the project to stabilization, which means it's a shorter time to cash flow to the investors, which means it's a shorter time as far as a better return to the investors. And by year 2 or 3, we're looking at anywhere from 20 to 30 to 35% of their investment coming back to them through the refinance. So it's it's more diversification. They can go into what they want. The amounts that come back out to them are much greater during that time period. It's all going to be before they owe taxes. So that's very accretive to their return. So I hope that was helpful. And I sincerely hope some people will join us in our breakout session and we can have one-on-ones.
No, sounds good. Let's get to a couple more questions before I kick you out totally.
Oh yeah. So this person's saying anonymous, Tennessee was on page 37. Okay. Yeah. So I think we had that on as a project in due diligence, but we didn't go through. So I think that was just something that was tangential, but thanks.
I've got a couple questions in the chat that you may not be seeing. Andrew asks, can you speak to any key person risks you have, and what have you done to mitigate? 10 years is a long time, he points out.
Yeah, that's an excellent question. It's somebody who knows their due diligence. By the way, we also have a due diligence portal that's completely loaded for investors and due diligence officers, so we can always send that to people to dive in. So this is a combination of two companies. This is USG Realty Capital, which me and my partners own. We're a real estate securities company. And you have OZI, who is a real estate, basically a development financial analyst company. So we've combined. On the USG side, I'm the CEO and founder of the company, but we do have a succession plan. So we have, right now it's set up for my partner, if in case I, should go away somehow, get hit by, as we like to always say, get hit by a bus. And then we actually are one of the few companies that has an advisory board. So our advisory board actually will step in to find a successor, but we have a line of founder and CEO, my partner, who's the chief accounting officer, and then chief operating officer. On the OZI side, it's Kyle Weesey, who's our partner over on that side as the founder and president. And they're actually a group of 7 on their founding board. And their succession plan actually drops down to their chief operating officer at this point. So, it's not like we're Microsoft, but we do have a plan in place in such case, because it is a 10-year-old. I'm 57. I'm not an old man, but I'm 57. I'm not, 37. So I come with a lot of experience and know-how. But on the flip side of that is my runway is shorter than a lot of other people. So, but we do have a plan in place. So thanks for the question.
Good. And let's see. Really quick, simple question here. Catherine wants to know, can I invest as an individual investor directly, or do I have to go through a broker?
Yeah, thank you for that question, because I failed to mention our distribution model. We take money in, mostly it's family offices and securities firms, but we have a complete direct invest. So we do probably 15 to 20% of each one of our programs direct with investors. They come directly to us. They get into the fund. We actually act as their financial advisor in the deal, and they have us for that 10 years. So about, I would say every 20 million of every 50 million that we raise, it comes directly to us. And actually, to be honest, that's growing. More and more people want to go direct to sponsor. So I expect that to be a bigger number. But yes, we do, and we do that a lot.
And that's why you're here today, right? So
yeah, a little bit, yes.
Greg, I'm going to cut you off there. I'm going to try to keep things right on time. We're right on time. Thank you for joining me, Greg. I'm posting the link to the breakout session in the chat one more time. It's the same breakout session link we've been using a few other times throughout the course of the day. So click the little chat icon in your Zoom toolbar, and you'll see the most recent message there from me has that link. Go there now. And Greg, you go there now too. And I know Chris is there. I've got him on my other computer right here. I'm looking at him, and he's waiting.
And I can answer these questions, right, at some point?
Yeah, you can answer those questions at some point.
Okay.
And, you may be able to address them in the breakout session right now, but I'm going to kick you off stage now. Get into the breakout session with Greg, or stay here and remain here with me and Ashley while we discuss successful OZI investing tactics. But I hope a lot of you do go over to that breakout session now.